UK house prices, October 2025. We've got high inflation, we've got government meddling, and we've got high interest rates, persistent interest rates that are all adding up to some downward pressure on house prices in the UK. So it's generally a buyer's market at the moment. A bit of a slowdown. So I'm going to go into some of the house price indexes here. I'm going to finish off each day to the end with, I think, what is the best house price index, which shows a bigger decline in house prices. And I'll explain why that is. But I'll start off these videos each month with a look at the overall economy in the UK. So we're looking for the main factors, figures are GDP, unemployment rate. So this will define if there is a recession or not. And if there is a recession, that's when you might see bigger falls, actual falls in house prices. And then inflation as well is eating into the actual real values of house prices. So we'll talk a bit about that. So we've got GDP at 0.3, which doesn't sound like a lot. However, this is quarter on quarter. And so a technical recession is when you see a negative GDP figure for 2 quarters. So anything that's above zero is actually not bad, okay. And so this is a table here of that figure and Q2 2025 here. So it's lagging. So you have to see what this quarter is, but 0.7, 0.2. So we're not going down. So in 2023 here, we did have a technical recession there, minus 0.2, minus 0.3. And so when you see more than 2, you have like a sort of a more secular decline in the economy. That's when house prices could really come under pressure. But at the moment, actually, that's not too bad. But the real kicker is unemployment. If that goes up, then again, you'd see declines in house prices if we see unemployment continue on its current trajectory. So this chart here is unemployment going back to 1971, so 50 odd years. You can see here the peak of the COVID unemployment here peaked at 5.3. And we are currently at 4.8. So we're not that far away from the peak of the COVID unemployment peak there. So that trajectory is obviously heading in the wrong direction. The real problem comes, so this is the 5% line here. So this is just before the financial crisis, going into the financial crisis, 2008. So you see when it jumps from 5 up to about 7, that's when you really see problems. So we're not that far away from 5. So it just depends if it keeps going up here. So if you like and subscribe, I'll keep making these videos, and you'll know when that happens. So we have to see if it happens or not. And then finally, inflation. So again, this is the year-on-year inflation. The target should be around 2. So we're about double what the target inflation should be, and we all know it's higher than 4.1% anyway. So again, this is a chart, annual inflation for inflation going back to 1989. This is COVID, so it kind of this doesn't really count. That was an artificially inflated inflation here, so we can discount that. But so, for example, again, when there's financial crisis, technical problems in the economy, you see inflation spike typically there. So, great financial crisis peaked out here at 4.8, and we're currently at 4.2. So again, we're not that far away from like problem levels of inflation. And of course, this has a knock-on effect of eating away at the actual value of homes. So as we'll see, that, for example, in the Halifax HPI, September 25, pretty recent. The only figure really interested is the annual change of any of these H price indexes. Ignore the monthly change, relevant quarterly. It's the annual change that you are only really interested in. So they're saying it's 1.3% annual change. So it might seem okay, that's not going down. But in real terms, it is going down because the rate of inflation is actually 4.1. So in real terms, you've got a negative about minus 3% per year. This is the problem with inflation, especially when it's above 2. It just eats away at your spending power, and it eats away at the prices of your homes. So that's house price index at Halifax. We've got here mortgage approvals, which is just so rather than HPIs, try and look at a few other indicators of the health of the property market here. So mortgage approvals being another big one. So on the year, it's around about kind of where it should be for August. So it's around about 64 to 75,000, 70,000 rather. So, that's okay. And on the 10-year, you can see it came down here because of the post sort of COVID decline when inflation was spiking. So house prices, or rather mortgage approvals, started to decline, recovered back to this sort of long-running trend here. So let's go back to 2016. So it's recovered. So that's an indicator of health in the property market. Although I'm not quite sure what to make of some of these statistics, because since 2016 we've had an extra million or so people in the country. So is this, again, in real terms, in the same way that inflation is actually bringing house prices down, in real terms, is this actually the graph actually going like this? Because if we're building more houses, more people are coming into the country, we're going to be buying all these houses, you'd be expecting this to go up, but it's flat. So in real terms, you can say this is actually going down, mortgage approvals. So anyway, I'd make of that what you will, but on the face of it, this is potentially saying that the property market is, sort of relatively healthy. Land registry data, this has got a ridiculous lag on it. So even though this is the latest one is July 2025, it's still lagged. The actual figures for July 2025 are still lagged. But anyway, for what it's worth, again, the year-on-year, the yearly inflation figure is rising by 2.8 compared to the previous year. Halifax is probably more accurate in terms of being more recent. However, it's still just mortgage approvals, whereas the land registry is mortgage purchases and cash purchases. And then, so Hometrack is another sort of big one. HPI has been going for many, many years, and they supply data to mortgage providers, lenders, all sorts of property companies and organisations. So they agree with the Halifax there. Running house price yearly inflation at 1.4%. And then demand is 11% down for prices at 1 million because of the potential changes that the government might be bringing in with the property tax. And there's fewer new listings at 500,000. Again, the Zoopla house price index is for August 2025. Their key takeaways here: the same issues with possible tax changes are speculated to impact homes valued over $500,000, which is a third of homes for sale. So, the government is sort of targeting these quote unquote richer areas, possibly. So you wouldn't put it past them to actually bring this tax in. Whether they do it or not, I don't know. If it comes in, it's going to cause absolute mayhem, because all the properties 500 to 750 are not going to sell. They'll have to come down, because why would you buy something where you'd have to pay a property tax when if you just buy something that's below threshold, then you don't have to pay the tax. So it will be a complete nightmare if you're selling at that price level. However, if you're buying, they could be doing you a favour here. So depends which side of the divide you're on at the moment. So what else did they say? So stronger price inflation at more affordable areas, so again up 2.8%. So similar to land registry there, but mortgage rates are stable, 4-5%, supporting demand, but unlikely to fall in the near term. So again, Hometrack is saying the mortgage rates probably not going to come down that much. So these high rates are putting downward pressure on prices, again, creating a buyer's market. And I think there's a lot of people that are going to come off deals onto these higher rates. So again, that could cause problems, putting further pressure, downward pressure on prices. And here, market activity is set to plateau. So again, buyer's market really, according to Hometrack, is what I'll read between the lines there. Zoopla again, so house price growth 1.3% a year. We got Esurv here, which I think is the best out of the bunch here. They base their house price index on land registry data, but they apply statistical analysis to account for the lag in that data. So for England and Wales, September 25 HPI. So slowing housing market reflects falling confidence. So these guys seem to be a bit more unbiased and honest. Uncertainty about the upcoming budget is overhanging the market, as we discussed before with the property tax. This softening is likely to continue till the end of the year. Prices are in retreat in a number of areas, and not least in southern England. And then they've got a link here, so you can. This is sort of freely available. You can click into the link here, and you get the data. Sort of, you can drill into the data if you want. So the real annual change here is probably closer to 3%. That's annual change there for England and Wales. And don't forget, that's nominal. So with inflation at 4%, that would be a real decline of 7% in 1 year. So you wonder the reality of what's actually happening to price valuations as opposed to just the headline prices. Possibly a lot lower than is actually you'd see in the news or anywhere else. So we've got a table here. So you can, as I say, you can read through this, and you can see going to these tables here. So for England and Wales, you can see this is 2024, 2025 here, and so things were sort of chugging along okay. 1%, 1.4, again, nothing high, and this is annual change from the past 12 months, 1.6, and then in April 2025, go to 0.3, May 2025, minus 1.3, June, minus 2.2, minus 2, and then that's increased to September to minus 3. So, you can see the trend, and this is in nominal prices, so in actual prices without inflation seems to, according to these guys, seems to be accelerating here. So just have to see if that continues or not, and I'll let you know.